Okay, so what's going to happen is next week college is closed, so technically I'm off and everybody's off. So we're not going to have a study session next week. But what I'm going to do is I'm going to post the lecture and the problems either tonight or tomorrow for chapter 8. So 7 and 8 will both be up there on YouTube for you all to view. Like I said, anybody watching this week, just understand that there's no college on Monday, so you'll have this up there as far as resources to use and helping you understand the material, particularly for chapter 8. Okay, for some reason doesn't want to come up here. Okay. So question number 1. Prepare journal entries for the following credit card sales transactions. And the first one, we have sold $20,000 in merchandise, which cost $15,000 on MasterCard credit cards, and MasterCard charges a 5% fee. So we're going to go ahead and we're going to have a debit to cash. I'm going to have another debit to credit card expense. And we're going to have a credit to sales. Like always, I like putting in my accounts first and then following up with the information. So the cash will be $20,000 less the 5% fee, which is $19,000. Uh-oh. Not a pair. And then the credit card expense will be the 5% fee, which is $1,000. And sales would be $20,000. If you have any questions, Brianna, go ahead. Feel free to come off mute and stop me as I'm going through this.
No, yeah, you're good.
Okay. All right. Next, tab number 2, record the cost of the sale, which is $15,000. So the cost will be, first debit will be cost of goods sold. Okay, we have just a credit. This is only 2 accounts that are affected. Cost of goods sold and merchandise inventory. So merchandise inventory will be next. The debit will be $15,000, which is what the merchandise cost. And the credit will be the merchandise inventory showing that it's sold, just as we learned in an earlier chapter. And that's all we have there. Keep getting these error messages. I hope this doesn't just go away on me tonight. All right. Tab number 3, we sold 5,000 of merchandise on an assortment of bank cards. These cards charge a 4% fee. So first we got to take out the 4% to figure out what our cash debit's going to be. So 4% of that is going to be $200. So I'm going to start out by putting cash. As our debit. And we're also going to have another debit, which is going to be credit card fees or expense. Come on. Thing's playing with me tonight. It's not letting me act right. Okay, so will be $4,800 debit, $200 debit, and then finally sale, of course, $5,000. Right, and then we're going to have to show the cost of the sale. So our debit's going to be cost of goods sold, and then our credit is going to be merchandise inventory. Both amounts will be for $3,000. And we'll go ahead and check our work. Well, I guess it's not going to let me check my work. Hold tight 1 second. Maybe we can get in there and see if it's saved. And it's not saved. All right. So much for that. Well, I can tell you that the numbers that we did put in there are correct. Because I worked the problem earlier, so we have all those are okay to follow. Next, number 2. Okay. Solstice Company determines on October 1st that it cannot collect $50,000 of its accounts receivable from its customer P. Moore. Apply the direct write-off method. Well, this is pretty straightforward. This is going to be a first a debit to bad debt expense and credit to accounts receivable. That's the direct write-off method. And the amount will be $50,000 debit and $50,000 credit. And we'll see if it'll let me check my work this time. And it does. How about that? I guess it finally got past its own mistakes. Right. Next. Question number 3. Solstice determines October 1st. It can, we just did this one. We go number 4. Gomez Corporation uses the allowance method to account for uncollectibles. On January 31st, it wrote off an $800 account of a customer, Steve Green. It received a $300 payment. So we have to prepare first a journal entry to write off Green's account. So that journal entry is going to be, all right, so this is where we get into the allowance for doubtful accounts. So we're going to debit allowance for doubtful accounts. Now, if you recall, the normal balance for allowance for doubtful accounts is a credit, okay? Then our credit's going to be accounts receivable to wipe off that amount that he owed on that account. On number 2, record the reinstatement agreement account. I know this seems like it's, walking around the block just across the street, but you have to go through this process. And so, because you're keeping a paper trail of everything that happened, you just can't eliminate steps here in order for the sake of expedience. It just does not work. So we're going to first, we're going to reinstate, we're going to have to debit accounts receivable for the amount, which was, in this case, let me see how much the amount was. We got back $300. Okay. And then we're going to have to put the money back into the allowance for doubtful accounts so far. So that's why we're going to credit it $300, which increases the amount of money we have left for other bad debts that we might have to write off in the future. And then we're going to have to record the cash receipt. So we're going to have a debit to cash. $300. And then we're going to have to get rid of the accounts receivable. And again, I know it feels like we're, going around the long way just across the street, but this is what you have to go through. This leaves the proper paper trail so that we have a record of what happened if it's a big question. And you can see that all is correct. Okay, next, the percent of accounts receivable method. Now the fun begins. So Werner Company's year-end unadjusted trial balance shows accounts receivable of $99,000. The allowance for doubtful accounts of allowance for doubtful accounts of $600 credit, which means that's the balance it has coming into the year. We get to use that in the next year if it's not used up. And then, we had sales of $280,000. Collectibles are estimated to be 1.5% of accounts receivable. This is the accounts receivable method. So we're going to take 1.5% of accounts receivable, which in this case is, I need to get out my cheat sheet here so I don't have to play on the calculator. Well, it's not telling me what 1.5% is, so I got to calculate it. So bear with me a minute. I'm going to multiply the 99,000 times 0.015. And so that comes to $1,485. Now, here's the thing though. We have a balance of 600 that we're bringing into the year. So after we calculate what the bad debt's going to be, which is $1,485, we're going to subtract the $600 from that. And so that means that we're going to go ahead and raise up that account by $885. And I'm going to put that in so I don't forget it. The bad debt expense is going to be debited immediately because that's got to be reflected in this year. And then allowance for doubtful accounts will be credited $885. Now that will bring it up to $1,485. All right, because again, we already have that credit balance being pulled forward. And is there a part two? What have been? Oh yeah, there is a part two. So what amount would have been used in the year-end adjusted entry if the allowance had a debit balance? Good question. So in the case of a debit balance, you have to add that to the $1,485, and that would be $1,785. That means we overspent in bad debts the year before. It comes across into the next year as a debit balance. So we have to know to add that. We're going to have to make the account reflect what we overspent last year plus what we're supposed to spend this year. I hope you follow that, Roger. So we'll check our work with this. And everything should be correct. Okay, BioWare's year-end unadjusted trial balance shows accounts receivable of $17,000 with sales of $150,000, and uncollectibles are estimated to be 2% of sales. So this time we're going to multiply times 2% of sales, multiplying 150,000 times 0.02, and that's $3,000. So prepare the year-end adjusted entry for uncollectibles using percent of sales method. That's relatively straightforward. We're going to debit bad debt expense, $3,000. And we're going to go ahead and credit allowance for doubtful accounts, $3,000. All right, next. Oh, here's where the fun really starts. Now we're gonna hit the aging of receivables. Now, it's a little bit different than what's shown in the book because we have to kind of make it work with the computer software, but that's okay. So, estimate the balance of the allowance for doubtful accounts using the aging of accounts method. We start off with the amount not due. And the amount not due is going to be 80,000. We're just going to be carrying this stuff down into the table. So 80,000 first. Round to 30 is 18,000. And 31 to 60 is 7,200. Next one's 4,000. And finally, over 90 is $6,000. Pretty straightforward as far as answering that first one. Then we're going to put the percent, all right? So here, you don't want to use decimals, okay? Here, it's going to be strictly whole numbers. So we have 1. Notice it automatically calculates it. 3%, 5%, 8%, and 11%. Wait a minute. Oh, I didn't put a percentage in it. Okay. All right. Now, under requirement number 2, let's see, we're missing something. Now we've got everything total. Oh, okay. We have to indicate whether this is a debit or a credit balance. And what this is, it's going to be a credit balance because that's what we're having to raise the amount up to in allowance for doubtful accounts. Requirement number 2. Next, we're going to actually put it on the in the general ledger as the adjusted entry. So, under the first one, it's going to be a debit to bad debt expense. That should be a pretty common theme now. We've done it just about every problem. And next, allowance for doubtful accounts. And the amount for each is, gotta read my writing here, 1680. Let's check our work. We're all correct all the way through. Okay, number 8. Computing note interest and maturity date. Okay, so on this one, we've got to figure out what the maturity month is going to be and then what the date is going to be. All right. The first one is 60 days. That's pretty safe. We know it's going to be at the end of April. May 15th, we count 90 days forward. That puts us in August. October 20th, if we count forward 45 days, that'll put us in November. Next, we have to add the number of days, the contract date, to come up with the maturity date. And in the case of the first one, it's 30 days. Or I'm sorry, not, well, it's 60 days, but maturity date is April 30th. All right, the next one, if we count ahead 90 days, it's August the 13th. And October 20th, we count forward with 45 days. That's going to make it December. Oh, I did it wrong. It's December 4th. That's right. Let me change that. Counted wrong. All right. And the interest expense for each one, let's see, our interest rate is 6% for the first one. So in order to solve for the interest rate of the interest amount, we have to take 60 divided by 360 times 10,000 times 6%. That gives us $100. Again, 15,000 times 8% times 90 divided by 360. That gives us $300. And 8,000 times 4% times 45 divided by 360. That gives us $40. Let's check our work, see if we got it right. And we did. On April 1st, Respond accepted $10,000 12-month 8% note from a customer and granting a time extension on their past due accounts receivable. Respond's year end is December 31st. Compute the interest revenue recorded by Respond in year 1 and year 2. Okay, so 12-month note, we're looking at 9 months. All right, now remember, we're using the 360 rule or the banker's rule for calculation of time. And this one, I'm going to kind of shortcut it. Well, no, I don't have to. So you're talking 10,000 times 8%. And let me see what I calculated here. 10,000 times 8% is $600. Well, no, that's what the final answer is. It would be $800. So $800 times 9 divided by 12. If that's reducing it down to its lowest numerator and denominator. So again, $800 times 912 equals $600. So year 1 will be $600. All right, year 2, and this the easiest way to solve this. We know it's going to be $800 total interest. So subtract the 600 from the $800 total interest. That leaves us $200. Or you can do it the long way. You can multiply 8% times 10,000 times 3/12, and that'll give you $200 as well. Either way will work. And as we can see in checking our work, it works. All right, I am going to leave this preparing a balance sheet because you've done one of these in every chapter now. So this should be, pretty easy to do. The one thing I will point out to you, I'll go through and I'll tell you where everything goes. Prepaid rent is going to be a current asset. Accounts receivable would be a current asset. Cash would be a current asset. A. Bennett Capital goes under equity. Accounts payable would be a liability. Allowance for doubtful accounts will be a liability, and notes payable will be a, well, I'm sorry, I should classify the accounts payable current liability, notes payable, and which would be a long-term liability. Allowance for doubtful accounts would be current, and notes receivable, which will go back in the asset section, that's going to be a long-term investment. Okay, and the only thing going in current assets are those things that can be liquidated in less than a year. All right, I'm going to move on. Number 11. Following data are for Rocky Company. All right, and here we have to complete the. We're looking at accounts receivable turnover. Now, you want a lower number. Wait a minute. Take that back. You want a higher number on this, showing that you're quickly collecting your accounts receivable. That's the purpose of making this calculation. All right. So let's see what we're looking at here. Gotta pull my notes out. Make sure I get the numbers right. All right, so on requirement A, we're gonna choose net sales divided by average accounts receivable. Our net sales, where did they go? Oh, okay. Net sales for the current year are 861,105. And accounts receivable, we have to add the two together and divide by 2. All right, they're making us work for this. So 153,400 plus 138,500 divided by 2 equals 145,950. And that's 5.9 times. Okay. Again, you don't want a low number here, because if you do, that means you're not collecting any money, just extending credit. Let's see, the next one is competitor Dixon has an accounts receivable of 7.5. Obviously Dixon's doing better. And we're correct all the way through. All right. Grande Company had credit sales of 20,000 in the current period. Accounts receivable had a beginning balance of 4,000 and an ending balance of 5,000. Imputed cash collections from its credit sales for the current period. So, here we're going to have to back into it. This would be a good quiz question, by the way. So expect to see something similar to this on the quiz. If you're starting off with credit sales of 20,000, let me take that back. Hold on a minute. So what you want to do is you're going to take credit sales and you're going to figure the difference between the beginning and ending balance of your accounts receivable. So in this case, it's $1,000. All right. Since your ending balance is lower than the beginning balance, that means you didn't collect all that 20,000. You only collected 19. I'm going to put that in there so I don't forget. However, if our beginning balance was 5,000 and our ending balance was 4,000, then you would add $1,000 to the 20,000. But that's not what happened in this case. In this case, we ended up not collecting on $1,000 of the credit that we extended during this current period. Okay. Dexter Company uses the direct write-off method. Dexter determines it cannot collect $4,500 of its accounts receivable from Lear Company. Lear unexpectedly pays its account in full to Dexter Company on March 29th. Dexter records its recovery of the bad debt. So here we're going to have a multi-step thing like we did earlier. The first thing we're going to do is we're going to write off the bad debt. Debit bad debt expense. And we're going to credit accounts receivable. If we weren't using the direct method, we'd be doing this allowance for doubtful accounts. But the direct method doesn't have an allowance for doubtful accounts. Number 2, we have to reinstate because he's showing up with money. I guess he's had a come to Jesus meeting and decided he needs to make amends. So our debit is going to be to accounts receivable. Credit is going to be to bad debt expense. is for the whole thing, right? Yeah. And then finally, we're going to debit cash. And we're going to credit accounts receivable. And checking our work. And all the entries we made are correct. Okay. In its first year of operations, CloudBox has credit sales of $200,000. Its year-end balance in accounts receivable is $10,000, and the company estimates $1,500 is going to be uncollectible. Prepare the year-end adjusting entry to estimate the bad debt expense. Okay, so in this case, under requirement A, we have to record the year-end adjusting entry. So that's going to be a debit to bad debt expense. And allowance for doubtful accounts will be a credit of $1,500. Requirement B, prepare the current asset section of classified balance sheet. Assuming inventory is 22,000, cash is 14, prepaid rents 3. Pretty straightforward. Okay. It's going to be cash to begin with, 14,000. And it's going to be accounts receivable of 8,500. Where do we get that from? Well, we got that from, where do we get that from? Oh, okay. We got that from, let's see. We're subtracting the 1,500 from the 10,000, and that's going to give us 8,500. I forgot to put in 14,000. Okay, next is inventory. And next is going to be prepaid rent. First 22. And prepaid rent is 3,000. All right, next. And Werner Company's unadjusted trial balance shows accounts receivable 99,000, allowance for doubtful accounts 600, $600 credit, and sales of 140,000. Again, this means that they did not use up $600 from the prior period. So when you make, I'm going to leave this alone, leave it for you all to do, but you're going to basically take 1% of 140,000 in sales, which is $1,400. Okay. And I'll leave it to you all. By now, you should understand what you have to do as far as recording. But make sure that you subtract the $600 from the $1,400. So you're only going to be debiting and crediting $800. This is again a somewhat of a repeat. So I'm going to leave you to calculate this on your own. If we already covered something similar. Remember, credit balance means we didn't use it all up last year. So you subtract it when you calculate what the uncollectible will be. And then when you have a debit balance, you're going to add it to what you calculate will be uncollectible. So A, you'll subtract it. B, you'll add it to 2% of the of accounts receivable. Okay. Again, this is similar to what we've already done. And given the fact that you have to set up a table separately, I'm going to pass on this one as far as working through it. But you set it up the same way as you did the last problem. And again, this is just like what we did earlier. It's just giving you the data in a different way. So again, I'll leave this for y'all to do. And this is the big problem. So here you've got a series of transactions that you have to put in the general journal. Remember, since you're selling product, there's 2 parts to every sale. So make sure that you're recording it properly. And that's my only hint for this. If you've gotten this far in your homework, you should know how to do each of these transactions efficiently. But as always, if you have any questions as you're doing your homework, feel free to reach out to me and I'll do my best to get back to you very quickly with the help you need to get through the problems. Again, I will be posting, hopefully tonight. I don't know if I'll get them all up tonight or not. Depends on how fast this video will render, but I hope to get up there the chapter 7 problems we just reviewed and chapter 8 problems. I already did those, and I'll also put the lecture up for chapter 7 and chapter 8, so you'll have basically the PowerPoints you'll refer to in the mode that I have up there. So again, let's see. Oh, we have an additional participant. Demetra, do you have any questions?
No, I don't.
No? Okay. So anyway, hopefully I'll get this up tonight because I know, Demetra, you might have missed some of what I went over. And Brianna, thank you for attending as well. And good luck with everything that you have to do. So like I said, I keep my email open all day long at work, and I check it when I get home. So I try to make sure I can get back to you in a timely fashion. Have a good week. Have a good spring break. Short-lived as it is, or spring break. So
Yes, fall break.
Fall break, yeah. Enjoy those 2 days if you can, and I'll be back in 2 weeks with a live session.
Thank you.
Thank you.
Have a good night.
You too.